Hey, this is Sasha Evdokov. Welcome to episode number 82, Day Trading Stocks, When to Trade, When to Sit, and some examples of day trading and some trading action, I guess, for today. Now, I want to share this with you because the market is set up in a way to do some nice day trading. We've had earnings, volatility is coming in, and I just want to share with you some thoughts about day trading. I haven't shared a lot of that in the past because I don't promote it as heavily, and I'll explain to you why that is. So first, before we get into that, just a couple of quick announcements. I am launching another little website. It's really more for beginning if you're just getting started. It's just a way for me to personally organize things so one website isn't fully cluttered. And I'm going to be coming out with investinghelpdesk.com, absolutely free. And it's just going to have frequently asked questions out there answered in video format. So we'll basically have the question that many people ask me time and time again, and that way it's just easier for me to reference those. It'll be very quick videos, it'll be more PowerPoint style, but it'll just be a way to answer your questions in more detail, so that way things are a little bit more clear. So I'll be doing that on some of the Tuesday lessons here as we continue throughout the year. Another piece of news is I also just finished filming the calendar section. It took about 23 full days to finish filming just the calendar section, and I only have one more section to go in the option trading course. Right now, looking at it, it's right around 45 hours of training. It's an intense course. It's going to be broken down into multiple courses. I don't have a tentative release date at the moment, but it's massive. There's a lot of learning, a lot of education that goes behind it. And really, I look at it as getting a PhD in trading options. At least there's experience that you're going to get from this course that probably no other course or person is going to do it in that way. I literally hold your hand throughout the different trades, and you get my time throughout that course, just my thoughts, my mindsets on real live market conditions. So that'll be coming out later once I finish off one or two more main modules and sections, which will be, I think it's the butterfly sections that we have remaining. Now, as far as today's market conditions and actions, I did want to share with you some day trading concepts. If we look at the S&P right now, the SPY, you can see we're selling off right about 80 cents, but the SPX actually, as of right now, it says it's down $7.90. But really on my screen, this is about 15 minutes behind. We're down about 14.42 points on the S&P, and it's rifling down quite quickly. Now, I didn't personally day trade today because those of you that have watched the previous episode from last week knew I had some allergy issues here this last week, and this week I actually got some blood drawn and had some tests done. So I wasn't around about half the day today to do the testing, to do the day trading. I was out doing the testings, and they were checking my blood and so forth for allergies and other things as well. So in either case, by the time I got back, there's really no point to day trade. But those of you that were watching the previous videos know and understand that I was mostly bearish on the market conditions. And the question comes down to why. Why was I bearish on the market conditions? So before you day trade, you need to decide an overall market trend. Okay, where is the trend, but then also where is more of the risk? Okay, so when I look at an SPX and we backtrack it, let's just say I look at a weekly chart. Even for day trading, I'm checking the weekly chart. So I'm looking at this, what has been going on and what's happening. How far are we extended? How far are we extended on that rubber band at those levels? Are we coming into some major weekly support and resistance, or are we stretched too far? And here, watching the previous video from last week, you know that I was talking about we're a little stretched quite stretched, and we need to move sideways or we need to pull back. And even a pullback to a 2,000 would be just fine, and then we can go higher. So you either need sideways digestion, consolidation, or you need a slight pullback in order to proceed and move higher. That is healthier. If it goes higher without that, then it's not healthy, and chances are it'll pull back even faster. And right now I'm just watching the market explode to the downside, 16 points now. So in either case, what happens is if you have a market direction, first off, overall, I look at it and I say the market's overall been heading higher. However, now I look at where is the risk. The risk is actually to the upside. What do I mean by that? I mean that there's little room for me to make money to the upside, because if it hits this line, it's going to be very tough to go past the line of 2130 in the S&P. So I also look at the next line where it's really approaching, which is 2100. That's another line of resistance. Now, we did break it slightly a little bit here the previous week, but again, we finished under that. So what does that tell me? That tells me that my more reward is to the downside because there's more risk to the upside. So now that I have this in play, I check it on the daily to see if this confirms my analysis. And if it does, then I move on to the IWM and I check to see how that's moving. Did we break it? Did we not break it? I check the QQQs. And by the way, everything that I'm doing right now, I do within this whole video that I'm sharing with you. This whole video that'll probably be about 20, 30, 40 minutes long, I do it within about 10 to 12 seconds, maybe 5 seconds, depending on how I am on the market. So all of this, think about it as I'm stretching this out and slowing it down to a 1 mile per hour for you. So here on the QQQ now, I'm looking at this upward trend line right here, and I see that the Qs also sold off. Why is that? Well, I looked at Google. Google sold off. We had a sell-off, little pop, continue sell-off. I look at CMG. That's got the major sell-off also from the earnings, helps push the market lower. If you look at Microsoft, another big player, sell-off continues. If you look at Apple, another major sell-off. Think about it. The leaders lead the market. It's like a freight train. A train has a leading mechanism. There's something that leads it, and then everything follows. So here we have these leading stocks going, and now what's happening? Well, the rest of the market's going to start kicking in because the leaders lead. And when the leaders don't lead, then there's some weird territories that you get into it. And I've seen it before, but it's really a concerning to me when that happens. So, for example, if we continue moving higher over the next few months, but these leaders like the Googles, Amazon comes out with earnings soon as well. If these stocks that are leading, that are overall leaders in the world, continue to sell off, but the market goes higher, there's something weird that goes on, and I wouldn't trust the market. So instead, when I'm looking at this, as far as earnings go, earnings help drive volatility. So now as you get into day trading, first I have this overall market position mentality that I say, okay, the market's a little bit overbought here. So what's in my favor is to short the market or to go to the downside. It's more favorable that it's going to pull back because a market doesn't go straight up, doesn't shoot to the moon. So in this situation, I go ahead and now position. I'm starting to think about positioning for the short side. Now, for me personally, I've already been putting on short positions over the last couple of days because that's where I was positioned, because the risk is more to the upside and the reward is better to the downside. So for me, putting on these positions it's good when you have volatility. That's when day trading is really, I guess, it works out, because when you get little patterns like this and the market doesn't move, you've noticed we had 1-2 days here and there where it was 1 point up, 1 point down, and the market really hasn't moved much. And when the market doesn't move much, that's really when day trading is really horrible, because you don't get that action within in the stocks. But when you have the volatility, like we're getting right now. We're actually, here, let me show you the screen. Look at this market. It's just an elevator coming down because people were, wrong side of the trade. If you look at the S&P, I mean, we're just shooting down right here. It's just a massive nosedive and really 21 points. We were up 2-3 points, boom, taking it out. So when you're on the wrong side, this is what happens and what you get clobbered. But professionals love this. What they do is they hold it up as long as possible, and then they rip that rug out from under you because then they see the buyers dried up. The buyers dry up, and when the buyers dry up, boom, they take it out. So for me, when you have an overall market direction, you know that the reward is more to the downside. You start looking at, when you're day trading, looking for opportunities to trade. Now, for day trading, I personally would not do it and do not recommend it when stocks are moving sideways. When they're barely moving like this, up and down a few points here and there, it's chump change. That's little money. That's pennies, because the market isn't moving. The volatility is low, and that's why big traders love volatility. They love when the market moves. Doesn't matter if it moves up or down. You're versatile. You just want the market to move. So what you do is when you see things like these big stocks like a Microsoft selling off in a big way, or you look at a Google selling off major, what other one do you have? Netflix or Apple. These are your day trading stocks. Now, of course, you can trade other stocks, the penny stocks, this, that, but these are more liquid. So once you start trading a larger account, it's a lot better to trade these. Plus, these move a lot more. When the traders start stepping in and taking these out, they go to these first because they want to protect their profits, or they know it's going to tank more because a $200 stock is going to move much more than a $4 stock. A $4 stock may move $1 in a day or 50 cents. $100, $200 stock is going to move, a couple dollars in a day. Looking at this one right here, you got Apple moving $2.67. So I'm looking for stocks that have high volatility. Here on Amazon, right now on Amazon, we had on the day we had a pop of 15, and then the reverse now we had a 20. So if you did that move, that action, you had a 20-point volatility spread move. So when do I trade? I trade when there's volatility. That's when you day trade. You don't day trade when you have markets moving sideways. When the VIX is low, typically when the market is moving to the upside, you will have a lower VIX. So you probably won't want to day trade. You can, but again, it's chump change. You're trying to milk it. It's not worth the headache. So for me, I'd rather just hold and do regular positions at that point. But once you start getting overstretched action, like over here on the S&P, you're getting to these highs and you're starting to see this to roll over, which we talked about last week. Review that last week's video. We talked about that action, that once you start seeing this, you start watching for opportunities if you want to day trade. Now, for me, again, full disclaimer, I prefer to swing trade. That is my thing, because you make more money holding a stock for days, weeks to come. And, if you can be patient, but it's very difficult. It's difficult to be patient because there's other factors you need to look at, and it's a hard thing to learn. The patience factor for many people is very difficult to learn. But with swing trading, just look at it right here. You can ride a stock for a couple of weeks. You got the trend line. You can ride it here for a couple of weeks. You can spend some time at the pool. You're not worried about it, stressed about it. With day trading, you can't really leave the screens. So when do you trade? You trade when there's volatility, when stocks have been selling off, because that's when you get whipsawed action. And then when do you sit out? You sit out when the stocks are typically going higher or lower by like 1 point, 2 points. When Dow Jones is up 5 points, 20 points, it's minimal. There's no point to trade then because the market is just acting sideways. It's calm. So you're not going to get a large return on a day trade. Okay, so keep that in mind. Again, this lesson mostly applies to day trading. However, for me personally, I prefer to swing trade. But if you want to day trade, here are some more concepts that I wanted to share with you of how to properly do it. So this is how you do it. You do it with patience. Day trade when the time is appropriate. When do you take a truck? On a road trip, when you have a large load in the back and you have 2x4s and camping equipment that you need to carry. When do you take a hybrid? When you're trying to save gas. So use the right tools at the right time. Okay, so next point. Let's take a look at the market. Oh man, this market's totally rolling over. When we look at the S&P, when do you short these stocks? When do you short them? Well, again, I have my overall position direction that is in my mind. Now I'm looking at it. It's bearish. It's overstretched. It's hitting these critical points. So now I'll zoom in on, let's say, the 15-minute. Okay. I'll tell you, I don't like hourly because there is 6.5 trading hours per day. And the hourly time frame does not break into that evenly on a bar basis. Okay. Whereas with a 30-minute right here, it breaks down evenly. 15-minute breaks down evenly. But with an hourly chart, you typically don't want to watch that. I have it here because I think it's a default. But in either case, you don't really want to watch that because it doesn't break down into it evenly. So to make your decisions, you want to do it on a 30-minute, 15-minute. You can look at a 5-minute, but with a 5-minute, you'll get whipped around. And a minute chart, again, you're getting whipped around because you have to take into account the meta volume, the meta pattern that we talked about last week when you're day trading. So let's say you start off conservatively and you're looking at a 30-minute. Okay, I'm going to backtrack it to about a 2-hour here just so you can see. So here I'm hitting some critical points and I'm evaluating what's going on with this this company, in this case the S&P. So now here I'm noticing this is hitting a high. It broke a little beyond it, and we rejected it. We did it twice. So when we come up a third time, that's your shorting point and opportunity. And that means the stock is still acting weak. Now, if you miss that point, then what do? Well, you take a look at it a little bit closer. So now we know and understand that the direction is down. We already determined that on the longer term time frame. So now I start looking at other little critical levels. Where did the stock change direction? Where was there a gap? Where were things trying to be defended? Things like that. So again, there's the next line I draw. Why do I draw this line? So here's why I draw this line. Number one, you have a little gap right there. Number two, you have a little bounce here. You have a third bounce here, but then the stock broke and rejected it. We have, again, now a rejection right there. Stock attempted to break it, but couldn't do it. Attempted a third time, couldn't do it. So where do you short? Well, I mean, here for today, what do? What happens? Well, look at it right here. That's your shorting point. Your shorting opportunity was right there. That's the first initial point, was right under this line where you see this 209.50 right there. That's your shorting point. If the stock pops higher, you get out of it right there, okay? A little bit, because you're day trading. If you're swing trading, you need more room and wiggle room. Okay, your next opportunity, okay, what happens? Well, you see the volume coming in over here, the red volume, okay? See, notice that red volume bar, comparing it to the other bars, they're a bit higher. You got that sell-off. Stock reattempts to break higher, couldn't do it, rejected it. That's your shorting point. Anywhere in that range, now you're shorting it. Okay, you short the stock and you wait till it comes down. Potentially, this was your initial point where the stock could have bounced. It couldn't do it, continues to sell off. So that's really what happened. That's what you're watching for. And you can apply this to any stock. You're watching the overall trend. How extended is it? Then you're getting in on that trend, whether it's to the upside or the downside. Right now, it's favoring the downside. And then as you get into critical levels, like this level here, you take profits, take half, because what if it now bounces to the upside? What if it bounces? Then what? Now you're back to even and you executed a trade put on risk for no good reason, because you're only on a day trade. You're not going to make a fortune. You're looking for scalping. You're really trying to nibble. It's kind of like trying to find coins and rings at the beach. It's kind of tough to do. So for you, when you get into this right here and it comes into it, you want to get half out, because the probability, again, where is the risk? The probability on the shorter term is for that stock to bounce, okay? For that stock to bounce. So you have that risk. So it's better to take half off that table. So that's what you want to do. And, that's what you're watching, is where's that next risk reward line. So you can see that some of these times you'll get a little bit faked out, because what goes on and what happens is you have this support line right here, but it broke below that. So you're wondering, where do I put the support line? Well, the swing point was right there. Another swing point was right there. This broke it, but it couldn't hold it. It bounced on there, so now it creates at that level. This was just little confluence, little meeting point. It's still a range. You got to think of these ranges when you're looking at support and resistance. It's really like a little range. We talked about that before. So it's like a little range like that. So once you start looking at these as critical ranges, now that should make a little more sense. And that's what you're doing. And you can do this to any stock. Let's do it on Amazon. Okay. Amazon. I checked the weekly chart. Overall, the stock bounces. Why? Okay, the stock bounces. We're coming into the swing lows. Okay, stock bounces. I come back to the daily, see what confirms here. Where are we hitting? Okay, we hit right here, hit this point. This was a little bit of a wiggle point right there. We bounced, we consolidated, broke higher. For the short term, this was a nice stock. Okay, now we're getting into this. This could be creating an A to B, B to C, and now we could see a C to D. Now, earnings are coming out today, so I wouldn't be holding this stock overnight because of earnings, so we don't know where it's going to go. But if you see this selling off today, you probably see the market continue going lower, especially with the action we're getting right now with a massive sell-off. So anyways, the overall direction of the market, let's say I'm still looking at it, let's say it's to the downside, then I'm looking at how these leaders are moving. How is the related companies, Amazon, Apple, Netflix, Google, all these stocks, not just Amazon, because I want to see the overall picture. That gives me the lay of the land. So now I'm looking at these swing highs. Look at this point. This stock, it's on the daily, that this stock right here came to these highs and it rejected it. It wasn't able to do it. And as it's rejecting it, look at this bar right here, that red bar, and then look at how this red bar right here is coming in. The volume's picking up. Then you had a second rejection, okay? When we look at that second rejection, look at that red bar. So bearish volume is picking up, okay? So if you missed it, okay, let's just say you missed that part, that's okay. Then you have more opportunities. The market gives you multiple opportunities. So now we know the longer term trend is down on the market. This stock is also rejecting daily moves. Now what do I do on the day? Okay, so now I look at the daily. Here's our daily part, and now I go back to see if there's a good entry point because I missed the earlier tops over here. So I see this swing point over here where the stock changed direction. So let me put a little bit of a move right there at the highs. And now as I zoom into that, look at how perfect that comes in. Now you'll notice stock broke lower. If we look at this, stock broke lower here on what? Heavy volume. Look at before we had bullish volume here on the dailies. So the shorter term for the, let's say a month or two, was to the upside. But now for the longer term, let's say 6 months, is to the downside. Things are starting to change a little bit of a direction, or it could be just earnings digestion that's coming into play. People are getting worried. So we now move higher. Right here, we move higher on lighter volume, bullish volume, and then look at when we have this little sell-off. That is bearish volume on a higher scale. Then we reject. Do we reject on lighter volume or heavier volume? Heavier bearish volume. Okay, we continue rejecting. Okay, is that bearish? Yes. Bearish. Is it heavy volume? Yes. Is it confirmed to our overall bigger picture? I'm talking now the bigger, to this big line over here. Does that confirm as well? Yes. The stock's moving lower. Our overall big picture was to the downside. Now the stock pops over here. The stock pops to this upside, but It pops a little bit on heavy volume, but this is what? The beginning open trading. So now we see what has happened in the next 30 minutes. That's why I say don't trade that first half hour if you're brand new. Stocks start to reject, okay? Then we realize, okay, this part is a rejection point. This is a rejection point, and now we get and short it right here at that 620 level. Okay, if it breaks 619 even, 619, you short it. So now what would you have made if you shorted it at 619? 619 to right here, $16 in 1 day. $16 in 1 day. Okay, that's how you trade it. But would you day trade? Would I day trade? Let me backtrack again. When would I sit out of these things? Would I day trade over here? No. No, absolutely not. There's no reason for me to day trade. Yeah, you can do, oh, the market's popping a little bit. And you might be saying, yeah, it's popping. And then look at those big green bars and it's moving. No, for those kinds of trades, I'm looking at a swing point. I'm looking for a swing trade because here, I noticed a consolidation pattern, and those were you that were in the charts. Right here, I said this is a nice area to get in, and it is. For a short-term move, right here, you hold it for 41 points. And that's not bad. For 41 points, you hold it, sit, because the market is just crawling up like a turtle. But to day trade, it's very nice to short when the stock is continuously pressing down and then you see this action start coming in. I'm not saying you had to catch it there that day or today. You could have caught it all the way up here. You could have caught it earlier. That's perfectly fine because what did that stock tell you? That stock was telling you that even over here, as we're coming into these highs, let's just draw this line across. Okay, look at this. And if we move this over, if we don't even look at that, let me zoom in a little bit. Now, let's look at it here. The stock right here had a little bounce point, okay? We broke it here. That to me tells me we're weak. Now the stock reattempts to go higher, rejects it here, and now we broke this point again, okay? We broke it lower. Now, the stock tries to crawl back up, ABCD pattern, right there, small ABCD pattern. And now look at this point here and this point over here. We try to get up to that point, that critical point. I'm not looking at this swing point because this was just intraday movement volatility. You know, you look at where the stock ended, which is right here, right? That's why you check the daily and the longer term. Stock's rejecting, continues to sell off. Boom, you take off half. Then what do we get? We get that stock to try to pop higher. You do a second time short and boom, take again half your profits. And again, now you should be half or 80% out if you're day trading. If you're swing trading, you'd hold it longer. But in this stock, we have earnings coming out, so you should definitely be out before those earnings come out. So you can do this with any stock. Google. Let's do it quickly now since we're kind of getting into a time allowed here already, 30 minutes. So here again, look, overall, big picture, like I said, I do this fast. Okay, so what do? I'm going to show you exactly the speed that I do it at. Okay, so here, I'm going to first check the weekly. I'll go to the monthly. I get the big picture lay of the land. I see that things are a little toppy. Boom, right there, toppy. Then I go to the weekly. I see here things are a little toppy again. I look at little points right there, little toppy. I go to the daily. I see those points line up right there. I look at the lines. Here's some critical points. I check these levels. Tried to break lower, couldn't do it. So it's crawling up, trying to hit these highs. Right there, still toppy, means it'll probably reverse unless it can break extremely heavy. We sell off on heavy volume due to earnings, doesn't matter what it is. We go down, stock pops, stock breaks. If you missed it, doesn't matter. Remember, market gives you multiple chances. Stock attempts to come back right here, rejects it, heavier volume, continues to sell off right there. There you go. From here to here in 1 day, 20-point run. Let's do the same thing with Netflix. Okay, let's take a look. Overall, where is the big trend? I look at this. We're hitting swing highs here, double top, okay, 2 points. Stock direction is down. We try to bounce on that direction for a smaller term for the multiple months right here. Then we break it again on earnings. There's a problem. We zoom in on it. If you're day trading now, you have a somewhat of a clear direction. The stock energy is to the downside on the longer term. So I would rather trade this to the downside. So here now I'm looking at where these swing points are. So I take it out to about a 15-minute. You could do 30-minute. You see, okay, stock bounced here, here, here. Okay, so here's my line in the sand. I'm looking at it. I go ahead. I see we had a bounce here, break right here. Volume is fairly heavy, good for Netflix. If we missed it right there on the break, you would have already been waiting on it right here, 1 point, 2 point. But if you didn't get it right there, you go ahead and look that it's trying to get up there, didn't even have the energy, it rejected it. Coming up here again, rejected it. Even if you missed those points, let's zoom in even a little bit further. You could see right here. Okay, so now next point. Okay, so here again, we reattempt, go down, have a bounce, break through, reattempt. So again, here's another shorting point. Here's another one. We bounced, boom, to the downside. But this is all based on the bigger picture. What's the bigger picture? Because I'm not going against the bigger picture trend on a day trade. You can do that, but if everybody's pushing it down and you're the one pushing it up, it just doesn't make sense to me, right? It's not worth my money. I would rather take that money and go out to dinner, go out and get a massage, go out, spend that money, give it to a hungry child, whatever. Use that money for a better means. Okay, so that's how you do it. And finally, let's just do Apple real quick. Again, longer term trend. Look at this: A to B, B to C, C to D to the downside. We get a little pop. Again, this also can be an A to B, B to C, and now we may get a D pattern, okay, right there. So overall, going to the upside, volume, what happens to volume as we head lower or as we head higher? Volume is decreasing. Now, as we break lower, what happens to volume? Increases. We break that trend line. Now what do? Well, you go ahead and you short the stock at that point because you're breaking that trend line if you want. But if you don't want and you want to wait until earnings are out, then again, you could do the same thing with Apple. It doesn't matter which stock. So here I am at the 10 minutes, and you can see right here, we break lower, we try to power higher, try to get into this gap right here. So what do I know about the big picture of Apple at this point for the next few days? The big picture is it's pointing down. Here is that rejection coming in, and the stock continues to roll over. That's how it's done. So hopefully this makes a little bit of sense. Again, I took this 20, 30 minutes to really, I do this within a few seconds. And I hope this really makes sense. After you do it for a while, you start really grasping it, and it takes time. Sometimes you'll spend a day, a couple hours on a chart to really figure it out. But you need to take the time to learn that, because then you need to be able to do it second nature, especially if you're day trading, because the market is fast when you day trade. If you're new to the markets, I recommend you stick to swing trading. You trade lighter, trade less shares, and definitely, I talked about it last week. I talked about it the week before. This market was set up for lower prices because looking at all these earnings, you can't push a market higher with weak earnings, and the technicals overextended. If you do, then you get larger pullbacks. It's very dangerous at that point. So eventually those things do come back. You can't just constantly keep pushing it. So thanks again for joining me. I hope you enjoyed this video. I know I don't do a lot on day trading, and that is simply for the safety for you, not to burn your money, because when you get the idea and concept of swing trading, the day trading is just, it's really chump change when it comes down to it. But it's also, the reason I personally don't do it is it takes up a lot of mental clarity. You need to watch that stock. You can't leave the room. If you're trading and you're day trading, let's say Amazon, Apple, I can't leave the room. It's hard to go to the bathroom, when you're day trading, because I don't want to leave that position, especially if you're trading 5,000-10,000 shares right here, and the stock's rolling. You don't want to see that spike higher because, you got a lot on the line. So here in this scenario and situation, you definitely want to watch the screens and don't leave the room. And in fact, have multiple computers set up, multiple internet service providers. So that way, if the internet goes down, that way, if your computer shuts down, restarts, power failure, you got a backup, all that good stuff. And that's what day trading is about. For me personally, I like to trade a little more calm. From time to time, I will do day trading when the conditions are set up. Today would have been a great day for it. But again, like I said, I was at the allergy doctor there getting blood work and tests and all that stuff. Believe me, I would have rather done day trading or done other things and make these videos for you guys. But anyways, it had to be done. But, is tomorrow going to be a good day to day trade? I don't know. You watch the supports, the resistance, overall the market conditions. Overall, we're as you can see, we're somewhat rolling over. You can see that curve on these stocks, and you can pick any stock. Look at this Amazon rolling over. Look at Microsoft. If you take the Microsoft out to the monthly, look at this, where again you got that little rollover pattern happening. Netflix, the same thing. I mean, you pick any stock you want. The leading stocks at this point, they're rolling over. Can we bounce here soon? Yeah, we can. Where would I see the bounce? If you're asking me, I would probably see the bounce around 2,000. That's a nice point. People want to see that point. There's some other shorter term bounce levels, of course, right here and right here that you may get. You may get more sideways actions before we get to go lower. And if we do get more sideways action, at least for a month or two, then of course you can see this market power higher. But you need digestion. You need people to get out of those positions. And I will tell you, embrace these market pullbacks, because when you embrace these market pullbacks, they set up beautiful charts. Just like when you had Amazon here on this bounce for this room of 137 points, you're going to get the same on these Googles. So think about it. You're going to get this Google at 605, maybe. I don't know exactly, but let's just say if you do, you get it at 605. Maybe you'll get it there. Maybe if we have a massive pullback, you might get it at 449. If we really have a massive pullback, you might get Google at 357. Very unlikely, but if you could get at 508, 600, that'd be nice. But you'll see. It depends on the scale of the pullback, but it creates great charts and great opportunities. I know it sounds against the grain, where everybody else's retirement is tied to the market, where they need the market to go up. For you, if you're an active trader, again, probably sounds a little un-American. You want the market to tank because it allows you personally to buy things at lower prices, because it creates opportunity. That's what happens, it creates opportunity and a chance for you to, again, get things at those lower prices. So anyways, thanks for joining me. Keep an eye out for those quick little videos that I'll be releasing at the investinghelpdesk.com. Again, it's my website, just going to be quick questions that I can answer on video for you. And truly appreciate everyone, all the positive comments, the kind words, the fellowship that you guys are doing with my channel, connecting with me. I definitely appreciate it. It means a lot to me, and that's exactly why I do it. It's enjoyable for me to see the light bulb go off, to speak and talk to some of you on the phone, and really play with your mind, I guess, and look at the charts. And really, when you start grasping that information, and especially hearing about those stories where it's life-changing, that's really what it's all about. So again, thanks again. Remember, do what you love, contribute to other people, but most importantly, live your life abundantly. And I'll see you next time.